Hello, conscious investor, and welcome back. I'm your host, Julie Hawley. For over 4 years, I've paired my background in real estate investing, education, and coaching to create powerful content for you each week. This podcast is where we take a holistic approach to investing by focusing on 3 ingredients to a life of personal freedom: health, mindset, and wealth. We'll talk about everything from passive investing through syndication and how to use your retirement accounts to boost your investing, to mineral balancing and gut-brain health, and into topics that cultivate your inner strength and resilience so you can thrive regardless of any of life's current events. And yes, those are all episodes currently available and linked in the show notes below. Join me each Monday for a mindset episode and later in the week for an interview with expert investors and health professionals so that you can experience your greatest health, strongest mindset, and build the wisest wealth. Alex, welcome to the show.
Thank you so much for having me, Julie. I'm glad to be here.
I'm excited to have you here as well. And I'm super excited, and I think you are as well, conscious investor, for the entry question of the day. What do you do and how did you get started?
Yeah, so I'm a commercial real estate investor and operator. I specialize primarily in mobile home parks, RV parks, and self-storage facilities. And I would say the high-level overview backstory on how I got started was I got into construction. I was an entrepreneur at a pretty young age. Got into construction out of high school because I had worked for some other contractors and figured I could do what they were doing pretty easily just with learning some YouTube videos. I picked some stuff up pretty quickly. I started building some clientele. I got good at, sales and customer service, but I didn't have like the skills in running and growing a business. So even though I built that up to making 6 figures, it was really stressful. I was working long nights and I started, thinking about flipping houses. Maybe that could be my pathway. So I started flipping houses and realized that was a pretty similar model to running a construction company. I was doing all my own work. There was delayed profits. And so I heard about wholesaling. It was a Ty Lopez video. I saw this Ty Lopez video and it just clicked. I was like, oh, wholesaling, I could figure that out pretty quickly. And so I started just going on Craigslist and Zillow, finding some deals in the Midwest that were pretty cheap and making little assignment fees. And so I'd say I started doing my first deals in like 2015, just learning transactions and sales, figuring out what worked. Then I got into lease options, kind of got into the Pace Morby crowd and learning about subject to and how creative can I go with this. And I just felt really limited in single family. Just no matter how creative I got, I felt like the profits were small in single family, whether we were wholesaling it, flipping it, or holding it. There was really minimal profits or upside. So started in 2018 studying, syndications and going the commercial route. And it was between apartments and mobile home parks. So we kind of had marketing out for both deals, and then a mobile home park presented itself. And honestly, we weren't really ready. We hadn't fully syndicated it at the time or decided whether we wanted to do a fund or syndication. We didn't really have a track record, so we had to sort of bootstrap it and fund it the best we could. So we just structured seller finance, and then for the down payment and capex, we brought in private lenders, and we just gave them a fixed rate and a little bit of equity, and they came in and held for 2 or 3 years during the seller finance period. And that deal went on to be very profitable. And as we bought the next deal, we kind of used that same model, and then we refined it over the years. And then we realized maybe we don't need to do this whole like complicated syndication or fund route if we keep it simple, focus on these smaller deals. And our capital raises are under $500,000 in that range, 300,000. We work with one partner, 2 partners, offer a unique product because they're not a limited partner. It's fixed interest. And then we still give it, so basically our partners are private lenders with, the benefit of high fixed interest and short project cycles, 2 to 3 years. And then they also get some equity for the depreciation and everything. Um, and again, we've worked to refine that over the years, and there's been thoughts of stepping into the, syndications, or, well, do we go into bigger deals? But at the end of the day, if, um, a lot of our cash flow goes to our private lenders. So a lot of our profits are coming from the acquisition fees and then the upside on the back end, right? So volume's really kind of our game. And so we focus on smaller deals. So over the years, that became our model. Like, we're not market specific. We just don't do flood zones, don't do tornado zones, and we want to buy deals that are pumping out. We can get up to a 20% cash on cash year one, so we can give those 15% returns to our lenders. We negotiate really hard to get good seller finance terms. Pretty much every deal we bought. Um, we're up close to 1,000 lots right now, just to give you an idea on our portfolio size. Up close to 1,000 lots, like 30 million in portfolio value. Um, and a typical property size is 30 to 40 lots under 2 million. That's kind of our bread and butter. And we structure really strong seller finance, usually 4 or 5% fixed interest, maybe 20% down. That helps us really offer high interest to our lenders. And then we're typically refinancing on the back end with the SCR. Excuse me. And like I said, not market specific. We, right now our portfolio is spread across the South. We're in Texas. We're in the Midwest, Missouri, Illinois, Ohio, and then some in our local area, in my local market, Coeur d'Alene, North Idaho area. So that's kind of a high level overview. Found what works. I tried a lot of different pathways, a lot of different modalities, a lot of different vehicles, and first venture into commercial, the profits were night and day, because we got a 50K acquisition fee on that first deal, and we held the asset, and it was like, okay, this is where it makes sense, and it pencils long term, like it's going to sustain all the debt payments. It was just hard to ever pencil anything for long term growth in single family. So since 2019, we've been full time focused on those three assets.
That's
and refining the
awesome.
model, learning every day, networking, growing every day. So yeah.
It's all relationships. It's amazing how much, everything. It's not just what we do in the real estate space, but I mean life, the world turns through relationships. That's how things get done.
Absolutely.
Yeah.
Yeah. And just to speak to that, yeah, it's been, you know, a lot of the relationships I built, capital providers, deal providers, it's been through a lot of social media, online networking. And so when you're doing that, when you're building relationships, raising capital online, you really have to even further build that trust and rapport. And it boils a lot down to like systems and processes. And um, so we're constantly refining our diligence processes, our underwriting processes, because we've got to make it as presentable as possible to be casting a wide net rather than just working with like our local lenders or hard money, or working with one hard money lender. And so when you're out raising capital and you're being in the public eye, yeah, it just requires you to be that much more thorough. And I think we got momentum pretty quickly. And mobile home parks, they've been popular for a while, but in 2019, we just kind of got a name for ourselves as like the mobile home park guys. We landed on some podcasts. People were starting to pull their money out of stock market and put it, what are these mobile home parks all about? So we caught a lot of momentum, and we've maintained those relationships over the years. Very grateful. But yeah, it's like, where would we be without relationships of any kind? My team too, and so grateful for my team. Can't speak highly enough for them. So shout out to them.
Um, but this is actually this is a really unique opportunity to ask a few questions that I cannot. You and I both know that people have social media presences, but not everyone is like very unequivocally saying, I am raising money off of my social media. And you and I both know that there are people out there
Yeah.
that are totally posing and peacocking as like, come give me your money, I know how to do this, and they really don't. And it's so
Yeah.
terrifying. I'm like, oh no, please, like, don't collateral damage, please don't get involved. So in your estimation, what are some ways that, private investors can actually, vet someone further? How can they see through the veneer over on the social platforms in your estimation?
Yeah, I think that's a really good question. I think the best, the best thing is obviously we give out references. I think that's important to ask for references. Of course, we all know that only goes so far. Maybe they're cherry picking the best references or whatever the case may be. But um, what I do is I give a long list of references. Uh, Over the years, I've just built that list as full as I can, and I know there's probably a mixed bag of experiences, right? There's been times maybe we had to extend the timeline or whatever that case is. But I know for me that I've always honored on those commitments. So what I try to do is I try to be honest and upfront out the gate when they say, I think a good question about, can you give me an example of when something went wrong or a time when you were off on your projections and how you handled that? I think that's a good base, blanket question as a private lender. And if someone's or a private investor, and if someone says, "Oh, there hasn't really been any issues," that's probably a major red flag. I like to be open and
Sorry, can we
upfront.
just laugh?
Yeah,
Can we just
yeah,
pause and laugh? Like, oh, we've never experienced anything like,
a
seriously,
hundred
like,
percent.
no.
Yeah, it's like no, let's hear what your procedure is around when things go wrong, and I think that's where we honor our investors and our lenders really well. Is we're honest about the fact that there's going to be unforeseen things, but what we do is we do everything we can possible to make it right. We also put personal guarantees on all our debt. That's sort of a unique added protective mechanism that we put on there. Not everyone does that, but for those who do, that's just that additional layer of saying that you believe in what you're doing, and if it doesn't go right, that we're going to do everything we can to make it right, even if we have to go into our own pocket. And there's been times that's happened where we had to dip into our own pocket. So I'll tell lenders this out front. I think that makes them feel really comfortable. He's honest about the times things went wrong. He's telling me how he handled it. So I think you know that right there, just making sure there's no red flags of it sounding like things are always perfect, right? Because that's never the case. Um, I think another one is just deal track record. Like a lot of guys don't ask, a lot of lenders don't ask me this much. Um, but for me, like if I'm coming in and partnering on a deal, I just ask like, what were your last three deals like? Can you tell me, did you hit your exits? Were you on target with your projections? Do you have to stop distributions? These are kind of all blanket questions too you can ask. And again, the key is not to know that they have a perfect track record, but that they're honest about it and how they handle it. You know, demeanor's everything.
I think
So
the concept of, I think like perfect track record, that to me in and of itself is a red flag. Because, I mean, man, you and I both know extraordinary investors, and like things happen, like floods, tornadoes, they happen. Like things
yeah,
happen that you can't, interest rates go through the roof all of a sudden. Like things happen that are
trends
out of your
change.
control.
Yeah.
Yeah. Yeah, exactly.
Absolutely. So yeah, I think maybe that was a long-winded response. I think I gave some nuggets of questions you can ask. Definitely like what were the last three deals? Have you ever had to do stop distributions? How did you handle it? Were you ever off target or upside down on a refi or exit? Just some blanket things. You can kind of poke at common areas where likely there's been some things and you want to look for honesty.
Yeah, but it's so important. I had some people that, I mean, like I'm always looking at different opportunities, and it's like, ah, that looks really great, and I want to develop. So I'm not afraid to say, I want to develop this relationship further. I want to mature this
Yeah.
relationship further before I place an investment. Let me just like get to know you a little bit more before we partner up. Let's get to know each other more. Like,
And I will say probably 50% of the, capital providers that come in on my deals, it was a long-term process where they came in, they were maybe interested or they've been watching my email distributions for a while and they say, maybe one, two, three deals of they almost pull the trigger and then we get to know each other through that process. Like you said, you build a relationship. they build trust that you're not all about the sale, that you're here to make sure it's a win for them. And when it is a win, those people end up becoming long-term partners. So, and I'll say too, maybe if someone is saying they haven't ran into major issues as an operator, not necessarily lying, but they might just not be that experienced. It might be another red flag that, well, they haven't necessarily been around doing it long enough to run into those issues. So
that's a fair point. So that leads to an interesting question, which is like exactly what we're talking about. But I've been having fun with this question on podcast recording day, and it was like, the best and the worst deal. Like, I'd love to know, and if you were looking at it from a private investor side of things, like what's like one of your best deals? What's one of your worst deals where you're like, oh my word?
Yeah. Okay. So the first one that comes to mind for best deal, I would say, is actually one um, that I bought it was in West Texas, and West Texas is sort of the oil field part of Texas where a lot of investors are speculative. That kind of cuts out maybe 50% of people who would say, I don't invest in boom markets or whatever the case may be. We did a lot of market research before going into that market, and it just the numbers were a no-brainer because of the demand for because of the workforce, their rental rates are really high. So our mobile home lot rents were like 700, 800 when normally they're 300 or 400, right? We had cabins, small studio cabins that were renting for 1,000 a month. And again, these are mostly oil workers. So there is that risk that, that boom could go away. Well, the boom never went away. We bought the property. It was generating about 4,000 a month when we bought it. It was very underutilized. Mom and pa, we bought it for 800 grand, and we brought it up for the past 18 months. It's been doing 20 grand a month. We brought it from 4 grand a month to 20 grand a month. It just appraised at 1.6 million. And this was just what's really impressive about such a short project cycle, right? To 2x the value of a commercial deal is not that impressive, but to do it in 18 months is pretty impressive. And we were just, we saw the vacancies. We saw the ability to come in and increase the revenue and the cash flow without having to do a lot of heavy lifting. And we took on that risk. And in order to take on that risk, we had to give up more equity because to get the investors to buy. And so the investors are right now, as we're in the process of selling and or refinancing, we're exerting both options right now. However much equity we pull out, or the proceeds will be north of 500,000, then the investors are going to get a nice share of that after already getting 15%. So we all together took a collective risk, and it paid in the end. I would say that was a great deal just because, again, it was very little capex. It was all a matter of just increasing marketing and operations. There was RV sites. We've kept that full. As far as the worst deal, I would say that's a deal probably. I used to have a past business partner when I first started my business in 2019. So we had built up a portfolio together, and then we in 2021 we transitioned, and I kept the company, and he's rebranded under a separate company. But we had right in the middle of that transition bought a property in Toledo for 2.8 million. And this was another risky deal. We don't do risky deals for this reason anymore. We've tightened our criteria, but this was another deal where vacant occupancy was dropping. The condition of these homes, it's 120 lot mobile home park in Toledo, Ohio. We bought it with recourse debt, commercial institutional recourse debt. So we had to bring in signers. We had to raise, I think it was $1 million in capital that we brought in. And we had, it was a lofty business plan to try and increase the occupancy and the condition of the home. Well, when we parted ways, that was one of the assets he kept. So I got my equity sold out of that. But come to find out, that whole deal crumbled. The banks come after him. He defaulted on the payments. The investors, the banks coming after them for recourse. And it's not necessarily at the fault of him, but it was bad timing with transition. I left, and so he was kind of running the team on his own, running that deal on his own, and it was one that needed all hands on deck. So I had my own kind of guilt about that, and I'm always checking in just to see how it's going, what we can do to kind of salvage it. But that's sort of the first deal I've sort of been a part of where things really went south. Like, what do you do at that point? It's literally appraised at less than the bank note now. So there's all kinds of issues, and there's back interest, and um, so I would say that's probably the worst deal right there.
That's,
Not necessarily a part of it, but secondhand still a part of it. Yeah.
well, that actually really raises like awareness on the whole point of like what's the health of a team, and not necessarily that you guys were unhealthy, but is this a team that's staying together, or
Right.
is this partnership going to dissolve at some point, which is going to, honestly, I've never thought of that, Alex. And I've you're the second team that I know that has parted ways, in the middle of a deal, and it happens.
And what's that
So
statistic? Yeah, it's probably pretty high. And as we're talking about, I think that's a great question. Of course, do you have any partners? What's that partner relationship like? Because that's just the reality at the end of the day. Not all partnerships are going to work out. And if they do, how's everyone protected in those situations? You know what I mean? And we had at the time, we were pretty green. So there was really no dissolution plan, right? We had to figure it all
right.
out as we went, and what investors were saying, how are we paying this off? Well, he was very bullish in that project and said, "I'll just buy you out." And so he kind of took on all that risk, and unfortunately, it didn't go as planned. But that's where, yeah, that's just another example of unforeseen circumstances. Things are going to happen. So
Yeah, I think that's like the number one thing I've learned over the years is like something is going to happen. In fact, as I'm talking with private investors, I always say like, "Hey, listen, at some point during this hold period, something is going to happen." Like
mhm.
that's the reality of it. Over the course of 3 to 5 years, life happens, and so how are we all prepared for that? What does that look like? Yeah, it's so important.
Absolutely. Yeah, and you can only it's like the 80/20 rule that we all know. It is like and that's how we treat due diligence and everything. Like if we try if one risk factor eliminated a deal, then we never buy a deal. Every deal's got some risk factor, is whether it's the population's a little questionable or but there's things that are non-negotiables now, which, for us, we just have certain non-negotiables that protect us from those specific things. There's market criteria that we're specific about. We want to be in counties. The population of the town has to have at least 10,000, and the population of the county has to have at least 50,000. And that might sound small, but when you're doing mobile home parks, you get into pretty rural markets
Yeah.
where we've bought parks with, hey, let's buy this park, 1,000. Yeah, there's only 1,000 people in this town, but it's close to a big town. Well, things can happen. And so protecting yourself that way, utility infrastructure, we just don't do septic and well anymore. Not that I advise everyone not to, but at the volume we're doing, it's just a lot. It's a lot easier to eliminate all those risks, dealing with
Yep.
well and septic. And so we focus on public utilities, and then occupancy, 60% plus occupancy, because we don't do a lot of infill. We're not the operators that are bringing in homes and renovating lots of homes. We try to be creative in how we increase the occupancy, and we try to be realistic. In our typical 3-year project cycle, we'll take a 60% occupied uh, asset, season the rent roll at 80% occupied, and everyone wins. But we're not trying to get it to 100% occupied necessarily. So just being more realistic as you get, you don't necessarily get better in underwriting over time. You just get more realistic. You know how to foreshadow things better, and so yeah, experience does help for sure. And I would say we're to a point now where um, we can move a lot quicker on these deals. It's important to know we don't do off market. I know a lot of people like off market. We used to target off market deals. We go directly to the MLS or to wholesalers. So again, networking relationships. We're all about relationships, letting those deals come to us. And so that really helps with the volume thing. We're doing, anywhere from 10 to 15 acquisitions a year. So, um, I think that's important to know. If there's any wholesalers, the brokers listening, reach out. We're always looking nationwide. So
I'm already thinking of somebody that I'm like, oh, I need to give you an introduction to this person because I think that that would be very synergetic for you. And
amazing.
I want to double down also on that concept of rural areas. I used to be very much, I like tertiary markets are fine, but I want to stay. I love the Midwest. And so it's like, okay, be in, strong cities in the Midwest where it's just what I call vanilla. It's so boring, but there's like the
Yeah,
level of risk is just you can always add sprinkles, you can add chocolate sauce. Like vanilla can get dressed up, but at the end of the day,
yeah,
it's going to be vanilla and it's going to be solid and consistent. And I love that. Um, but living up north of you, up in Bonners Ferry, I mean, I never lived. I grew up in California. Kids are born in Denver, and living up here in this town, it's a county of 10,000, but the
hmm
the community is, technically like 2,500. And then just living here, I can see the strength of investing in small towns
yeah.
where people are going to
It's
go.
like, how do you use the population as a criteria? It's hard. Like, obviously, that's a metric to look at. But then again, I compare Coeur d'Alene, which only has a population of like 40,000 or something, 50,000, and relatively small. And so, um, again, and like you said with the vanilla, some of the best deals. I mean, to this day, if we look back over our track record, all the best deals have been in those vanilla markets for sure. Um, and so we're always doubling down in them. And there seems to be a lot more mom and pop in those areas too, and a lot more upside and even more deal flow. So it works out.
And oftentimes less competition. Everyone
Less
else is
competition,
hungry. They want their rocky road and
low hanging fruit. Yeah. And the smaller deals are low hanging fruit. Everyone complains about these smaller deals. The main concern is the exit. Well, I'm here to tell you we've exited just fine on the majority of our small deals. There's still people who want small deals and buyers. Banks still want to put debt on them. So it's just, yeah, it's a different model, but we've been able to prove that you can do it on a small scale, large scale. We don't have to go into those larger core assets, which again, it's just harder takes longer to close, longer to form DD, longer to raise capital, less conversion. These smaller deals, like by the time we go into contract, we've done half our DD.
yeah.
Um, and it's scalable. So
It's funny. I'm getting ready to head out to the Midwest to do DD. I just got off the phone with the team today, and it's like, okay, book the flights, get ready, let's go. Came on. So,
yeah, yeah,
yeah,
you're ahead of the curve. That's awesome.
yeah.
So you're
It's
doing on-site DD. I love it.
oh my gosh, heck yeah.
I mean,
I really
you personally,
yes.
yeah.
Yes,
Okay.
yes. So we'll go out there and it's just important. I think for me, since I primarily work with private, investors,
Yeah,
being on site, laying eyes on it myself is really powerful and it checks a huge box for me, right? Like I want to know it's a little bit the healthy control freak that says I want to see this myself. I want to walk it myself. I don't want somebody's, secondhand opinion about it because their opinion might not be my opinion and how they see it might not be how I see it. And if I'm bringing in a substantial amount of private, equity, then I want to make sure I know what I'm standing behind and what I'm representing.
absolutely. Yeah. And I've noticed that for myself because, most time we're dealing with pretty generic assets like with the self storage and the mobile home parks. A lot of that DD, like my project manager goes out. We have commercial inspector phase 1, like all these things done for the most part. And we do video walkthroughs. The investors feel pretty protected on those, but for like as I've bought some local projects and then been had now hands-on involvement, like a motel I bought here in downtown Coeur d'Alene. We bought Wolf Lodge Campground. I noticed the difference of me being on site. It's just that added layer of seeing things that other my project manager is not going to see, you know, that my site managers aren't going to see, and so it's a gift and a curse because obviously I can't be everywhere at once. And I think even at the level of DD that we did, it would be hard. But now I've made it a point that we're doing quarterly travels, even to our current portfolio, going to check on our portfolio quarterly. So there's just less surprises when it comes to appraisal time on the back end. Because that's what we're noticing. That's one thing is that we're constantly getting better at is, it's like full transparency. You go close on a deal, you're kind of ready for the next deal, and then operations takes over that last deal, and then you 80/20 it. Well, that 20% matters when it comes time to refinance and get the appraisal. And then so it's kind of that shotgun approach. My team's like, hey, fix these issues last minute. Well, if we can be ahead of those by like having us on site, quarterly, that's kind of what we're starting to plan out. And then that gives us a more clear idea on how to hone our market a little more. So it is a little more feasible to keep it at least within proximity of visiting quarterly site visits. Right.
Oh my gosh, I'm chuckling because that's a point of conversation. My husband wants to build out a smaller portfolio. He wants to invest in a different way than I invest, and that's great. And in that process, we've created this criteria of, okay, we have to have a market where we can transact repeatedly. Like it's not just one off. We need proximity to an airport. So, and then for us, because we live in the inland Pacific Northwest, it's like, okay, what's the fly time? Like maybe I want to go to
What's
North
the
Carolina.
connection? Yeah.
North Carolina, there's now a direct flight to North Carolina. Like, heck, maybe I want the portfolio there just because I know I can get a direct flight,
Not a bad market. Yeah.
and it is. I'm like, we're developing right now. Like, my company's developing in the Tri-Cities area. So I'm like,
well, it's a great point. I mean, that's why people invested in Atlanta. They loved Atlanta because it was a direct hub. Direct flights anywhere in the U.S. So obviously, from market analysis standpoint, it checks a major box. It's something to consider. Us in Spokane, we can't get everywhere in a direct flight in the U.S. And so, yeah, if it takes a layover to get somewhere, that's something to think about. And yeah, fortunately, like for us, we've always, from the beginning, we've been a remote team. So we've got team members all over, and we've got, my project management team travels. Most time we're just using third-party vendors, local third-party vendors. And once you build that team kind of in an area, then we like to be able to, we can scale those contractors maybe up to 100 miles. Like we have parks that are maybe 100 miles, and we'll park from each other, and we'll use the same contractors, maybe pay them a little more, but we at least get that economy of scale, not having to fight to find new contractors and stuff. So if you go 100 miles in any way, that gives you a pretty good range of, we've got multiple properties in different states even that are being managed by the same contractors and stuff. So
yeah. Yeah. Oh, I hear you. And I can even think of a path in the Midwest where it's like you can just buy in this city, that city, that city, and just like fly in here, drive your way through, fly out over there. Yep. You've got your contractors. Like, yeah.
Yeah, you've got the whole Indianapolis up through yeah, like I said, that's to this day one of our best markets, has been the Midwest, a lot of Ohio. And then again, you're fighting a little more with not being on private utilities. Once you go into some of those rural Midwest markets, there's a lot more private utilities. And again, I don't advise against it, but that's just one major, I guess, unforeseen thing that's really hard to budget for. If you've got 10 septics and 3 of them go out or they weren't properly inspected, that can just be a major ongoing issue. And now you've got violations on your hand. And same with the well. We just dealt with that at one of our parks, another park in Texas, where the reading on the well just came back. We had just closed on the property. The well was inspected. Everything was fine. Then the first reading after we closed came back with contamination. So we're dealing with all these EPA issues and stuff now. And it's just like, why add that to the bag of risks? And so.
Because vanilla is great.
Yeah, it is. It is.
Can we get some t-shirts and we'll make them available? Conscious Investor, you vote on this, email me.
We buy vanilla.
Yeah. I buy vanilla. I like vanilla assets. Like I
love
invest in vanilla.
We'll get vanilla ice on it too. He's
Yeah, I love it. I absolutely love it. Gosh, Alex, this is awesome. I really appreciate your time. Like it's insightful and it's especially special. Like just our proximity of like somebody else in North Idaho in the Panhandle. It makes it's really exciting. Um,
yeah,
just connecting with other investors. Doing big projects, and I love it.
yeah, absolutely. And just to build off that, I've gotten comfortable just doing everything online. A lot of what I do is remote, and so now that I've started more recently getting plugged into the local community, yeah, it's really profound. Just the people that I'm meeting and how much activity is going on, and Anthony and Sarah, people that we both know, and just and Eric, and these events that are starting to go on. And so, yeah, I mean, it just again shows the power of community, and I love what you're doing, what you're about, attaching purpose and mission behind it, and it's exciting and timely for me because I would say I'm really just in the beginning phases of that. Like I've kind of just been in the building and growth phase, and now I'm at the part where it's like, hey, what am I doing all this for? And now I'm meeting all these people who are helping me get clarity around that, and I'm getting opportunities to give back, and so it's really cool and amazing. Yeah, just excited to see where these next couple of years go.
It is exciting, and I know like just having the Conscious Investor Growth Summit the last couple of years, it's exposed me to so many more people in the area that are active investors, that are passive investors, that are just amazing human beings, even if they're not investing yet. It's just sometimes you don't. And Conscious Investor, I want you to hear this. Wherever you are, they're extraordinary people, and it's just a matter of raising your level of awareness and putting yourself out there. And next thing you know, you're like, I'm surrounded by the most extraordinary people, and they've been here the whole
Yeah,
time.
yeah, who really want to see you win. I mean, of course, there's bad apples everywhere, but it's like the people who are going to these communities are people who are naturally growth minded, and it's like you don't have to fight and to find people in a crowd that are aligned. You go to these events, and the energy is there, and so the passion's there. Yeah, it's I think that's the best advice I could give, especially for me, because I'm one who likes to kind of isolate myself, and how much can I do without actually having to go out there and put myself out and socialize. Um, but the reality is, like, whatever business, whatever venture, like, we can't get there without people, team, investors, clients. It's all about serving someone, right? And so, yeah, cool to be with people who see that.
That's so awesome. That's the best way. If the conscious investor is just jazzed, they're stoked, they're like, oh my gosh, I want to connect up with Alex and learn more about what he's investing in and what he's up to. Best way for them to connect with you.
I would say either my Instagram, Alex Donnolo, at Alex Donnolo. That's got all my links on there. It's take you to my website, or my website is just alexdonnolo.com. That'll give you more information on what we do. So yeah, and
Awesome.
thanks again for having us. Really honored and grateful to be in your proximity.
Yeah, likewise. It's amazing. I'm so grateful. In Conscious Investor, there is so much in this conversation that's really helpful. And it's interesting because we've had like this mix of conversation where we're talking about a lot of active investing thinking, but through the passive investing lens at the same time. And so I know that this conversation supported you in taking that first or next step on your investing journey. Make sure you reach out, connect up with Alex. And remember, adventure belongs on the trail, not in your investing and not in your personal life. So if you need some support in either way, just make sure you head over to the official website. It's an affirmation, remember. I am a consciousinvestor.com, and let's get connected up there. Until next time, cheers to your health, your mindset, and your wealth.